Welcome to another edition of Focus on Alternatives, sponsored by ADISA. ADISA is the Alternative and Direct Investment Securities Association. For more educational content on this, please check out the resource library at adisa.org. My name is Geoffrey Dohrmann. I'm the CEO of Institutional Real Estate, Inc., the publisher of Real Asset Advisor magazine. And I'm joined here today by Alexander Anderson, who's Managing Director with Time Equities. Today we'll be discussing the merits of global property investing, what adding non-U.S. real estate exposure can do for a portfolio, as well as some of the issues and challenges associated with implementing a global real estate investment program. So welcome, Alex. Glad you could join us. First question for you, Alex, is why international real estate?
Sure. And thank you, by the way, for having me today. It's a pleasure to be here. But why international investing? So international investing for us has really been a way to just further diversify ourselves outside of our U.S. portfolio. We're in 36 states throughout the U.S. So our international investing in both Canada and Western Europe was really a way for us to just experience more diversification from a geographic standpoint and from a currency standpoint as well.
So what does that do for an individual investor investing in a program that's global in scope? What does that do for their portfolio?
It just gives them, it's the whole philosophy of diversification and everything, no different than how people look to diversify their financial portfolios with a little bit of real estate and some equities and so on and so forth. For us, this really gives people the opportunity to benefit from the cycles that are all different from one another throughout the entire world.
And you know, you're moving all over the world looking for these opportunities out there. Does it generate more attractive returns? And you mentioned diversification, and one of the benefits of diversification usually is the lower volatility. Does it, in fact, do that to the portfolio when you add?
So from a return standpoint, yes. Typically when you're buying at very deep value, low cost basis, you're getting first off, a much better yield on your investment to start off with. But then there's a lot more upside potential when you actually go through the repositioning process and you ride the cycle of whatever country that is that you're coming out of. So, 2020 was a perfect example where here we were in the U.S. where everything was getting overheated and everything was getting expensive, and we found it very challenging to actually find good investments to buy. So, being that we were over in Western Europe, there was opportunities that were surfacing because of the pandemic and providing us with just simply better yield, where we could go in and buy assets at a much lower cost basis and generate above average returns that we would otherwise couldn't find here in the U.S.
Now you mentioned earlier currency issues, and obviously if you're going overseas you're going to be dealing in other currencies than the dollar. How do you protect investors against currency fluctuation risk?
So everyone always asks, like, do you hedge? Do a hedge on the currency, and that's something that we normally wouldn't do, or we may do a partial hedge on an investment of ours. But we're really looking at countries that have very strong governments and very strong budgets and very transparent banking systems. So that's really kind of where we're targeting, our specific investments. It's not like we're going into Russia or Mexico or other much more volatile marketplaces where the currency risk could actually have some impact on you.
And you're dealing in different cultures, you're dealing with different regulatory environments, you're dealing with different tax regimes. So somebody going out and investing in a program like that, what are some of the things that they should do to make sure that they're well equipped to deal with all of those issues in a proactive, positive way? So
our philosophy has been we like strategic partners. So we're not one just to go in and just tackle something all by yourself. Because there's lots of unknowns out there, as you mentioned. So when we decide that we want to go into a certain marketplace, we'll go in and actually interview other real estate operators that are aligned with exactly kind of our philosophy. So, and then we'll actually partner with those individual operators and joint venture on deals together.
So you're structuring joint ventures with local real estate operating partners who are in the market and understand the market conditions.
Yes, and have various influences and connections, and just can provide obviously better value for someone from the overseas marketplace like us. But eventually, once we get attuned to the marketplace, we will then actually start off and go out and buying our own stuff. which is what we typically do. But we start off with our partners, and then once we feel comfortable doing it ourselves, we'll do so.
So let's take an investor or an advisor who's recommending to an investor programs who hasn't had experience with international investing. It's going to be a little scary, a little different. What advice would you give them to be able to kind of ease their way into the market and get comfortable with investing overseas?
Well, I think you have to look at, again, I wouldn't do it all by yourself. I think you should partner or align yourself with a long-time operator that has a clear success and a track record over there, us being one of them. But again, we're not the only ones out there that have been doing this. So I would be just very, very careful in terms of who you partner with and pick the right jockey, so to speak. And that's really the best way to approach international real estate investing.
And if you're going to be looking to decide which jockey to put on your horse, what are some of the things that you should be thinking about? In other words, what kind of quality should an investment manager who's going to successfully implement a global program carry with them and bring to the table?
I think you have to have a substantial amount of, transparency, again, is one key component to it. But financial backing and the ability to survive a marketplace and have appropriate amount of reserves in place to take risks, but also be there to carry a project or a acquisition strategy if things kind of don't go exactly as planned. So that's something that a lot of people look to us, to do so, is that when we go overseas, we're putting in a tremendous amount of our own capital into these deals ourselves, way more than the actual investors are, which provides a level of comfort for the investors that are really just kind of riding alongside of us.
So let's take an investor who's moving into this area for the first time, or maybe an advisor who's going to start recommending international investment programs. It's going to be new. It's going to be a little scary for them, perhaps. What advice would you give to people that are moving into this area for the first time? What steps should they take to be able to ease their way in comfortably so they can feel good and confident about the investments they're making in this area?
So they should really do their due diligence on the investment sponsor themselves. What has their track record been in that marketplace, and what is their commitment to that overall strategy? And I think those two in themselves really go a really far way when you are looking at international marketplaces. You also have to pick the right partner in that sense.
How much time should somebody spend in that area in order to really feel comfortable, do you think?
It's not a matter of how much time you spend if you want to invest internationally, yes, I would definitely recommend that you go overseas, go visit that marketplace, submerge yourself in the culture and the way of doing business, and learn the rules of government and all that stuff. But then ultimately, what you want to do is pick the right partner to go in on a deal together that has a track record in achieving various different successes and strategies over there.
And would you recommend that somebody go into one region, like maybe the UK that they feel comfortable with, or France, or Germany, or Japan, or would you recommend that they take more of a broad brush stroke and invest in multiple regions, multiple countries? I would
definitely suggest that you invest across a variety of different countries. As you know, there's different currencies and different government going on in different places, all that subject themselves to various different levels of risk. So investing in the UK, you have the Brexit dynamic. But then if you're investing over in Holland, which is a very sophisticated company, very strong government, then very strong currency, then that's you're offsetting the UK risk. So you have to just be very careful in terms of where you're investing, and make sure that you have strong governments, strong budgets, and just create as less of a volatile portfolio as possible.
So let's assume that I'm an investor, or maybe I'm an advisor to an investor, and I buy the idea that global diversification is going to be a positive attribute to introduce into my portfolio. What are some things I should be thinking about before I take my first step?
So you should be thinking about how does rule of government work? How do the various tax laws work in that country? What are my financing options? Are they accretive to the investment? Are they not? And then again, most importantly, would be picking partnering with the right operator, whether they are coming from the U.S. and they have a track record overseas, or if they're a local operator that knows the market very well and has influence and connections and can help you navigate all those various different ways of doing business in that country. That would be the best way to approach.
What if I, as an investor or an advisor, doesn't really have the resources to go do all that stuff, and I've got to really rely on an investment manager to do that for me? What are some things I should be looking for in that investment manager to assure that they're going to be well qualified to handle those issues for me?
Well, you would want to make sure that investment manager has experience investing overseas too, and not just in real estate, but understands the overall global and also local economy and the various different implications of making various investments. I mean, one thing to keep in mind, especially when you're investing overseas, is you have different tax implications as it relates to taking distributions and bringing them back into the U.S. or vice versa. So having an investment manager that actually understands the distribution network of how you can make investments, but then make it also an attractive investment to come back to you, in the United States.
Is the reporting going to be different for somebody that's investing globally as opposed to just somebody who's comfortable investing in the U.S.?
Not exactly. Financial statements are financial statements. Of course, you'll have other line items on there that may be foreign, but again, those will be defined, accordingly in the financial statement. But you have global accounting and audit companies out there that know the inner workings of how to handle international investing. So if you partner with if you're with a financial advisor that utilizes a certain accounting firm and audit manager, then all that stuff should be very transparent and easy to understand.
And we talked about this a little bit, but maybe we can expand on a theme, which is risk. What kinds of risks exist as an international real estate investor, and what should you be prepared to handle, and how can you mitigate some of those risks as an investor?
So one of the biggest risks is the stability of the government. You could end up buying something overseas, and then the next day you may not own it anymore. So the volatility of government and control in certain countries is definitely a large risk over there. In addition to that, you have the financial markets when it comes to lending. That's one of the biggest challenges that could mess up an investment, where the financing may be available one day and then it may not be there the next day, and that could create a hiccup in that investment. Right now, of course, over in Europe, you have tremendously low interest rates that can provide much more attractive yields. But again, that may not always exist on a going forward basis. Other risks would be, who are you invested with? And have they had experience with investors and having them as partners? And how do they report to you? And what is that level of transparency from a distributions and cash flow standpoint?
What about environmental risk?
You definitely have to take that into account, no different than you do here in the U.S. But again, there are the same thing here in the U.S. We have property condition reports and you have environmental studies. All that same stuff applies overseas as well.
And financing risk. The financing regimes are different in other countries. Everybody doesn't have the same access to, property financing. How do you deal with those risks?
So that's really where you have to you hone in on countries that have very stable, very transparent banking systems and are not being influenced by third parties that you typically wouldn't want it to be influenced the banking system. There's a lot of corruption overseas when it comes to banking, and you have to just make sure that you don't get involved in those types of those countries.
Yeah. Now, the other thing is currency risk, and how can an investor approach that issue? Because currencies fluctuate from country to country. And I've seen situations where people's investment gains can actually get wiped out, particularly if they're concentrated in one currency, right?
It is true. Of course, there's always the option to hedge the currency risk. But at the same time, you could also look at investing in different countries as a way to diversify yourself between different currencies. So you can make the same argument for the U.S. dollar. You may want to have euro exposure as well, and the fluctuation of between those two currencies and other ones that you may be subject to could all just level themselves out. So it sometimes isn't the best idea to hedge your currency, because it can in many cases go the other way on you, and it kind of messes up the diversification that you were trying to achieve.
And we all know that leverage can be a two-edged sword, right? It can amplify returns, but also amplify risk. What would be your recommended strategy from a leveraging standpoint for these kinds of investments? Or does it vary from country to country and vary from property type to property type?
So you should always look at the merits of an investment based upon the unlevered returns. So what is the property or the investment that you're making, yield without financing? Financing really is a bonus tool. It allows you to boost cash-on-cash returns, depending on whether or not you do interest-only debt or you have amortizing. But it also allows you to de-risk your investment or portfolio, because you can pull money out, depending on, of course, if you're doing it on a non-recourse or recourse basis. So there's many different ways to utilize financing to increase your return, but also de-risk it in that way. And again, every single country has their different ways of how that works, from writing up the financial documents. But again, that just adds to the further diversification of the portfolio.
If you were going to bottom line it for the people that are watching in, what would you say, what would be the one thing you'd want them to leave thinking about in terms of international investing and adding international diversification into their clients' investment portfolios?
So I think you should be definitely thinking about adding it to your portfolios. It is, like I said earlier in the conversation, it is a very good tool to diversify yourself into other marketplaces, other currencies, and other investments. And if you partner with the right people, the right financial advisor, the right operator, then you're going to have good success doing so.
Okay, great. So thank you, Alex. Thanks for speaking with us today, and thank you all for joining us. We really appreciate it. For more information about global property investing, or to see other videos from the Focus on Alternatives series, please visit again adiza.org.